Lenders 20 questions on pass-throughs and K1's video 5. What is the risk exposure of the owner for the different pass-through entities? Well, filing the 1065 partnership return, there's 4 possible entities. One is the general partnership, which is the riskiest possible exposure for the owners. There's always more than one owner, for one thing, and every general partner is an agent for that company. Any general partner can sign a loan, can sign a contract, and the partnership is bound to perform under that contract. This is true even if the partnership agreement itself says that one partner can't sign. All that means is the other partners can now sue me, but it doesn't mean that my company doesn't have to perform based on what the one partner signed. Put that along with this one. Every general partner is jointly and severally liable for all of the partnership debts. So I never have 100% control, but I always have 100% liability. Very scary. Now, a limited partnership will also file a 1065. A limited partnership still has at least one general partner, so somebody is on the hook for the whole thing. But the limited partners themselves are more like investors. They cannot be involved actively in the management or operation of the business. And for that, in return for that, they have limited liability. They won't lose anything more than what they've put in already. Now, there are times that limited partners have call provisions in their partnership agreement, so they might have to come to the table one more time, 2 more times. But for the most part, limited partners, what they put in is what they've risked, and they're not still on the hook. Also, limited partners are very unlikely to have guaranteed any of the debt. Then there's the limited liability companies who choose to file the 1065. The risk exposure of LLC owners, called members, is more like a corporate shareholder. They have limited liability unless they have personally guaranteed debt, unless they have poor business practices and keep forgetting to sign as president of the company. They also do have liability to the Internal Revenue Service if the company doesn't pay payroll taxes. But for the most part, they have limited liability unless they have released it. Then there's this 4th entity that can file the 1065s. In some states, it's called a limited liability partnership. In other states, it's called a professional limited liability company. Those companies are made up of licensed professionals, the architects, the doctors, the CPAs, and the attorneys. And we just can't limit our professional liability by an entity choice. Thus, the importance of malpractice or errors and omissions insurance in those entities. And then finally, the 1120S, it's filed as by S Corp shareholders. That is a corporation, and those shareholders have the same limited liability of any other shareholders. Very similar to the LLC owners. If they haven't guaranteed debt, if they have good business practices so they aren't sloppy in signing as Linda Keith instead of Linda Keith President, Linda Keith CPA Inc., and if they're paying their payroll taxes, then they have limited liability. If you enjoyed this information and you would like to receive all 20 free videos of the top questions lenders ask and should ask about business, personal, and global cash flow from pass-through entities, along with a copy of my tax return analysis quick reference guide, visit the URL on your screen.